What is going on, guys? Ryan DeFreitas here, bringing you another quick video about what is a PIP, about high-low volatility um, trading sessions, the best time to trade, and also, last but not least, consolidation and breakouts. All right, so let's get right to it. So, if you were like me when you got into the trading game, I knew what pips were, but I didn't know the real definition of it. And everyone talks about it and throws that term around, but I didn't really know exactly what it was. Well, simply put, it's percentage in point, guys. That's all PIP stands for, is percentage in point. It's literally the smallest price change that an instrument or currency or commodity, whatever, can move. That's it, guys. That's it. All right. So there's actually two types. It's called micro pips and then pip. A lot of people get these confused, so I'm going to break that down to you. So what a micro pip is this fifth decimal point right here. Boom. That is a micro pip. A regular pip is right here, the fourth decimal. This is important to know, guys. All right? Because a lot of people get this confused and they'll say, I'm up 10, 20, 50 micro pips when it'll be pip. Or they'll say I'm up 10, 50 pips when it's really micro pips. All right? So, for instance, if you're looking at the bottom one, if you're at 1.00053 and it goes to 1.00063, you're up a pip, okay? But let's go back to the top one. If you go 1.00044, so it's 44 instead of 43, you're up one micro pip. I hope that makes sense, guys, okay? So 10 micro pips equal 1 pip, if that makes sense. I know it's not that hard. Come on. Work with me here, all right? So let's go into how that plays with the market, okay? So I opened my charts up. You know, I was a little slow with it, all right? Now, look in the middle of my chart right here. Now, when there's not a lot of pip movement, right, that's low volatility, right? Because there's not a lot of people buying and selling. It's not a lot of traders making any positions or whatever, right? So as you can tell in the middle, it was kind of low volatility, right? But in the middle, after a few hours here, right here in the middle of my screen, after a few hours, you see how it's going up and down, up and down, up and down. That's high volatility. Why is this better? Because your potential to make money obviously is greater, right? Why make only $100, $200 when you can make $700, $800, $900? So you want to focus on trading on high volatile markets, if that makes sense. I hope it does, right? So that brings me to the third subject. When is the best time to trade? When is high volatile markets, right? Well, the best times are London session and New York session. If you guys don't have this chart or kind of know what this is or when to trade, I will have this in the group. I will also put this in the description of the video so you guys can have it as well. So just to give you general understanding, London session opens at 3, closes at 12, right? I mean, so that's a good time to trade. Also, New York opens at 8, 8 to 5. Also good time to trade. You have the overlap from London to New York around from 8 a.m. to around 11. A lot of people love that because it's that London New York overlap. What does that mean? It's very, very volatile because now you have the combination of both the most popular sessions together, if that makes sense. So you also have the Tokyo session, which is for the night owls, which is 7 p.m. to 4 a.m. This is all Eastern Standard Time, guys, by the way. The market and the forex is Eastern Time, so you guys should know that. So the Tokyo session is more accumulation, so it's not as volatile as London and New York, but it's still very tradable, just so you guys know. Sydney session is from 5 a.m. to 2 a.m., but most people don't trade it. I don't either. It's just crappy sessions, all right? Just being honest here. So let me finish up by telling you guys about the breakouts and the consolidations, all right? So just so you guys can understand, it's very similar to the low volatility, high volatility. They all come together. It's like the same stuff, just different names thrown out there. Okay. So I kind of highlighted with this gray box, or blue box, I guess I should say. This blue box is highlighted, and this is what we call a breakout. Why? Because it's now entered a completely new zone. So as you can tell from before, it was kind of consolidating, and it was kind of low volatility, just going back and forth, back and forth. Then it broke out, boom, shot down like crazy, right? This is another breakout from the bottom kind of zone that shot back up into the previous zone. All right, now I highlight with the yellow box, kind of a consolidation. Think of consolidation as a slinky, guys, right? How it's just compressed, right? That it's just compressed. It's ready. I mean, you can throw it and it can be expanded like crazy, but it's just being compressed right now. That's all consolidation is, and low volatility. That's all that is. You know, a lot of traders aren't trading, and that's really just not a lot of buys, a lot of sells. I mean, it's pretty simple. Again, right here, I kind of highlighted another yellow box, which is indicating like consolidation, right? Another consolidation zone right here, and then you can tell like right here with this big blue box that I highlighted is another breakout. And really that's all it is, guys. It's just kind of understanding the consolidations, the breakouts, high, low volatility. I mean, that's pretty much it for this video. I don't want to make it too lengthy. Kind of want to make it straight to the point so you guys can understand. I hope I broke it down enough so you guys understand it. Like I said, my name's Ryan DeFreitas. Add me. Also, subscribe to the YouTube. Let me know if this helped you out, guys. I'm going to keep posting videos to try to help out the newbies and anyone that needs it. So, peace.